Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is our friend Rafi Farber from the Endgame Investor. Rafi, it's great to see you.
It is great to see you guys too. I'm always happy to be on.
Yeah, it's an absolute pleasure having you on, Rafi. So, you've made a few videos about the inflation chase, Rafi. Can you explain that briefly for our audience?
Yeah, well, what I term the inflation chase is when the Fed is not out in front of rising prices, so they have to chase it,
Mhm.
right? So right now we have the CPI going up way faster than the Fed would have liked to admit 2 or 3 months ago. The transitory narrative is completely falling apart, as we all knew it would. It was a joke,
Mhm.
and now they have to get out in front of it. Except now, what generally happens, let's say in like 2008, right? Inflation started to I don't even want to call it inflation. It's not inflation, it's rising prices. Rising prices started to get out in front of the Fed, and
Mhm.
they shut down the printing. And if you look at 2008, the money supply stopped expanding and actually fell on a quarterly basis, on an annualized quarterly basis, around September 2008, which is exactly when the meat of the crisis hit,
Mhm.
because they were shutting down the money printing and trying to stop the rising prices. And that's what led to the financial crisis. So now we have a situation where back then there was no QE, there was no any of these weird, funny money stuff that started in 2008. So the Fed had a lot of room to get out in front, which it did,
Mhm.
and then immediately prices started to fall. Now we have, just to keep the semblance of an economy growing, of a huge debt pyramid that is about to topple. You have to have them printing $120 billion a month. And they say they're going to stop it. They're going to slow it down by $15 billion a month. So basically, the Fed is running $120 billion in the wrong direction,
Mhm.
while rising prices, what the mainstream call inflation, is running in the opposite direction. So if the Fed is going to chase inflation, first it has to stop running in the wrong direction, and then it has to shrink the balance sheet, and then it has to raise rates.
Yeah.
So there's a there's a lot that it has to do first in order to get out in front, and there's no way that it can do it. It's way behind the curve, and now we are in a situation where the market, meaning basically consumers, it's now up to consumers how much they're willing to pay for standard, basic necessities.
Mhm.
And they are it's them who's going to call the Fed's bluff. It's not really now the Fed against the financial markets. It's the Fed against consumers. And the Fed can take on financial markets. It can control financial markets for a long time. It cannot control the psychology of consumers. That is impossible. The public is much bigger than all central banks combined. We call central banks powerful when they are, but they're not as powerful as the public. And now the ball is in the public's court, and that's how it's different now.
The Fed's sort of gradually beginning to taper. They're dialing it back. As you know, their announcement back last week was they're going to reduce it from 120 down to 105 in November, and then I
Mhm.
guess progressively each month the strategy is reduce it another 15 billion. And then hopefully they think I don't know, is their strategy they're going to get it to zero and hopefully nothing's freaked out, and then what's the next thing? You raise rates, or do they have to start shrinking the balance sheet?
I don't know. It's also irrelevant because,
You think they'll get to
I
zero,
mean,
or do you think it blows up before that on the
I
taper?
think I think the CPI, as they measure it, or the PCE, or whatever they measure, is going to come in so hard and so fast
Mhm.
that the market is going to say, look, we're pushing rising prices faster and faster. So you're going to have to step up the taper, not 15 billion, not 30 billion. The market is basically going to dare the Fed to tighten faster and faster. And
Mhm.
that is going to start hurting the bond market, and that's going to start hurting the debt bubble. It's going to be a game of chicken between the market and the Fed, because the Fed has already played his hand. It's saying, okay, now we're going to start tapering because we see that rising prices are starting to rise faster and faster. So we got to do something. So the market's going to say, oh yeah, you want to do something? You better do
Mhm.
it fast. But
Yeah.
things are going to start unraveling quickly now. Like in a matter of, every CPI report, everything that comes out is going to be a very big event, and you're going to start seeing gold and silver trade with the taper instead of against it. And silver is actually very important here, because silver is money for the public. Gold is money for the banks and the financial system, but silver is money for the public. When the public panics, they don't go gold, they go silver. So in 1970, from 1978 to 1980, you saw silver really get in front of gold. So if we're really in that situation, that's what should happen.
So Rafi, how will this sort of, you think the dare is going to be like in the 10-year bond? Is that what people should be watching? You know, how the Fed's likely to be pushed around by the bond market?
The Fed is going to be pushed around by the rising prices statistics, whether it's CPI or PCE, and bond market also. I mean,
Yes.
the bond market is going to keep falling, and interest rates are going to keep rising. Not every day. There's going to be wild swings, because when foreigners, basically, when they see that prices are rising domestically in the United States, they are full of bonds. So what they're going to do is, you know, sell the bonds, and then the dollar is going to show extreme strength for maybe a day or two, and you know, people, and then people in the U.S. can say, oh, the dollar's really strong, let's buy the bonds back, and you're going to see like these wild wiggles. But the trend is going to be higher interest rates, lower bonds, just like it was in 1970 and 1980. We're repeating that scenario, except from a much, much higher precipice. So whether it's the 30-year, the 10-year, we just saw a horrible 30-year auction. We're going to see rates on the long end of the curve go higher. And yeah, we've been saying that for years. It's going to happen, and inflation is going to call the bluff, because the only ones buying 10-year, 30-year bonds are other central banks. So I mean,
you mean people don't want to take 2% interest on a bond? Doesn't make sense when CPI is at 6%. You mean real investors don't buy that?
It makes sense if you're a cartel of central banks that is trying to keep the currency regime intact by buying each other's bonds. It's basically a giant central bank circle jerk, and it's obscene.
That's basically taking yield curve control off the table, right? So if they're not buying, or is there some other way for them to manipulate yield without actually buying or selling bond? I mean, I don't know. You tell me. You're the expert.
Is there a way for them to manipulate yield?
Yeah.
No. I mean,
or just jawboning it, really?
They'd have to do it by continuing to buy bonds. I mean, but they're basically they're in the final stage of this. They can't control it for much longer. I mean, central banks can buy and sell each other's bonds and keep their rates suppressed, but as they do that, the public is going to take over in each of these countries. The Japanese are going to start bidding up prices in the street, and in Europe they're going to start bidding up prices in the street. Food's going to come more expensive, and people are going to start rioting. And you know, people in the UK already can't have to choose between heating their homes and eating, and the shelves are getting barer and barer, and the backups at the ports are becoming worse and worse. So the more that each central bank prints currency for their own country, it's going to make the situation worse, and eventually the public is going to revolt. So this whole regime of controlling rates is almost over. It's a matter of months now before you know, one of these inflation indexes hits double digits and people just freak out.
I think that's really key, is what you just said about food, because I've seen one example of this is fertilizer, ammonia prices, which is a derivative, I think, of
natural gas,
which has gone through the roof. And
wow, do you know how like how nice it makes me feel to use the word derivative in a real context?
Okay. Right. Hey, I used it right. Yes.
No, but like in a real asset context, instead of talking about like some ETF that's a derivative of a derivative of an option, talking about a derivative of natural gas, a real thing, ammonia you need to eat to fertilize your crops. I mean, it's good to talk about real assets for once.
Yeah, but I mean, it's literally farmers can't afford
fertilizer.
Even corporate level, you know, mass farms. It's like the price of corn, the price of wheat, the price of a lot of farm commodities does not justify paying these prices for the fertilizer. So how does that then affects crop yields per acre? I mean, this all trickles into 20, you know, the next, the current crops that were just for 2021 are pretty much over, at least in this hemisphere. But next year, this really means a lot, doesn't it?
Yes, it does. We'll see if we're right about this, right? That this isn't a supply problem so much as it's a monetary problem. We'll start to see what's happening here is that the entire economic system is starting to reject money substitutes, these paper money substitutes, whatever we call them, fiat currency, whatever you want to call them. This is a money problem. So what's happening is at the most basic of commodities, of things that humans need to survive, they're becoming more expensive in these money substitute terms. But if we're right, then in terms of silver and in terms of gold, in terms of real money, you're going to see, even though you have skyrocketing dollar prices, you're going to see these basic commodities fall in gold and silver terms. We won't see that dramatically until the very end of this process, but that's basically the market saying, look, we need a real money here. So we're going to destroy the supply of these things in dollar terms, but we're going to be begging for real money to circulate. So we're going to make it really, really cheap, even though the supply is hurting, just to get the gold and silver out of circulation so we can restart a monetary economy again. That's the end stages of hyperinflation in dollar prices or fiat prices or whatever.
Rafi, do you believe that we finally reached a pivot where the more they hike, the more it'll push precious metals up and then bonds lower?
I can't say for sure. I don't want to say, yeah, absolutely 100%, and then I'll look stupid. I mean, it could be, a little bit further out.
Hey, we'll delete the video. There'll be no evidence. Let's say whatever you want.
Yeah. Look, the last time we saw this pivot point was January 1977. January 1977, we saw the CPI saw like a sudden burst higher, and then the Fed started hiking the federal funds rate in January 1977. Then there was a low bit in 1978, took off again. So yeah, we are going to see, basically, when you have inflated bond prices like we have now, of certainly negative real rates and also even negative nominal rates in some areas, that's all fake value, because everybody knows that the bonds are not worth that. Yeah. And so all this fake value is piled up on balance sheets that doesn't really exist, but that keeps all that money out of the system, right? But when it starts falling because people in the street are selling, or even one central bank breaks the cartel, whether it be ECB or even the Bank of Australia, or even if one central bank breaks the cartel and starts selling, then these bonds are going to start falling, and then all this stuff is going to come out, out of the woodwork, and bonds are going to start to fall, and interest rates are going to start to rise, and everyone's going to know that the monetary system is collapsing, and they're going to go to gold and silver, and the people in the street are going to go to silver. The banking system is going to go to gold. You're going to see both of them go up, and silver go even faster, because the public is much more powerful than the global banking system, especially when they wake up all at once. We saw it in Silversqueeze 1 in a very strong way for about a few hours. We saw it, but imagine that happening weeks and weeks, week after week. That's what we're looking at.
You and some of your friends, Andy Schechtman and Chris Marcus, were working on taking delivery of one contract from COMEX. How did that turn out? Has that been finished yet?
Okay, so there I was able to get delivery of the warrant. After and the video is being produced with the help of Rob Keynes' staff. Nice. Of Gold Silver Pros. I don't know exactly when it's going to be finished, but it's all the material is there and it's being put together. Hopefully it'll be pretty soon, and you'll hear the story about that. But I'm the first Interactive Brokers client to ever get physical delivery of a warrant. And by physical delivery, I don't mean I have the bars. That is turning out to be a major issue, and I don't know if I will be able to do it. I will take another stab at it if I fail, with a different brokerage. But I am the very first Interactive Brokers client ever to successfully take delivery of a warrant. Nice. And what warrant means that, what does that mean? A contract is a right to a theoretical 5 bars of silver at 1,000 ounces each. It's fungible contract for any 5 bars, doesn't matter which specific ones. A warrant is a right to 5 specific bars held in a specific vault that weighs, whatever those 5 bars weigh. It's not exactly 5,000. In my case, it's 5,101, and it has a serial number. So theoretically, the next step is to liquidate the warrant, and then it comes out of the registered stock of COMEX, and then it becomes mine, and I send it to whoever I want. Now, Interactive Brokers is refusing to do that for me. They say that under no circumstances will they do that. They say that it's possible to transfer it to another futures commission merchant, who will then do it. But I mean, I have my cousin used to work at the COMEX, and he knows these people, and he's trying he's trying hard for me to figure out a way for me to get these bars, and it doesn't look like it's going to work. So I'm probably going to have to sell the warrant, go short and deliver it into the next delivery window, and get out of interactive brokers and sign up for a brokerage that explicitly supports loadout. Loadout means physical delivery.
Okay, so you have currently 5,000 ounces in the eligible category.
No, it's in the registered category.
What's that?
It's in the registered category.
Okay.
I'm not going. It's in the registered category. It's eligible if I take the warrant out. Eligible is private stock. It's not sellable for contracts. But I can't liquidate the warrant because they won't let me. Even though, I mean, theoretically, I was thinking about this. Even though I can't get the warrant, if theoretically, the silverbacks can break up into groups of contracts and just stand delivery for warrants, which is possible, which I've done, and just not sell the warrants, they can descend on the entire registered supply of silver and just take contract after contract and get the warrants and just not sell them, and in that way squeeze the COMEX. If that's something you want to do, it is possible. Loading out is a different question. You got to get a brokerage that explicitly supports that. But even then, even if you get a brokerage that explicitly supports physical loadout, if they start to see that silverbacks are joining the brokerage and insisting on loadout, they're going to start getting nervous and they're going to try to get out of it.
So you own 5,000 ounces at a specific depository, but you're not allowed to just send your own Brinks truck to go take it out of the system.
No, I have to get, because the warrant is actually legally in the name of the brokerage. So I've called the COMEX directly and asked them, can I liquidate my warrant? And they're like, no, it's not yours. It belongs to your brokerage. They have to call us. We can't even talk to you. So the whole system is designed to frustrate you and make it impossible.
Yeah. Well, there's another metals exchange in London, the London Metals Exchange, LME, and they had, I don't know if you've seen this. They this was just in the news the other day, what's going on with copper. And I don't know if you recall, about a month ago, or I forget the exact date, they had a big concern that they weren't going to have any copper for delivery, that they could actually run out of copper in their warehouses for the LME. And so now this came out the other day that they're considering changing the rules that would block traders from doing withdrawals from the warehouses to prevent it from running out entirely. I don't know. Are you familiar with this?
Yeah, I did some coverage of the copper situation and the backwardation there. I was not aware of this new article. That is very interesting, and it is not a surprise at all. This is going to be the same situation in all futures contracts, in all of them, whether it's cattle or beef or potbelly pig. I don't know whatever it is. The pork bellies, is that what it is? Yeah. Frozen concentrated orange juice. If we're going to go to trading places, whatever. What's going to happen at the end when the dollar really starts to fall? The prices of all these commodities are going to get really, really high, and people aren't going to want futures contracts in order to increase their dollar holdings. They're going to want the stuff. So you're going to start seeing rule changes in this, rule changes in that, and then it's the entire futures market of all commodities that people are going to lose faith in, and it's going to disintegrate if they can't deliver, and it'll just be irrelevant.
Yeah, it's really interesting. I wrote this tweet the other day, but my sort of response was, price solves everything. Why don't they just let the vaults empty out, copper go way up, and then the price will skyrocket, and that solves the issue, right? People will want to dump more copper into the LME system if the price rises higher, and boom, it gets refilled. I mean, I don't know why they're trying to block copper from leaving the warehouse. Why not just let it go? Let the price fluctuate.
It probably affects silver too, eh?
No, they don't want it. Yeah, it'll affect all of them. What I believe why they're doing this, we're at the point where the dollar, where all commodities trade on dollars because dollars is a reserve currency. We're at the point where the dollar is losing value so quickly. Even if prices rise, you'll still see these term structures locked in backwardation. It's not like prices have just risen. They've risen, they've risen in a way that the backwardation in these term structures, and I'll explain what that is in a second, have not resolved themselves. Meaning the prices rise, but the spot prices rise faster than futures prices. So that encourages destocking, because if a spot price for, say, copper is more expensive than a futures price for copper, then you have an incentive to sell the supply into the market now, to get that premium, instead of buy cheaper spot, store it, and then sell it in the future, which would encourage stocking. Now, but copper has been in backwardation since mid 2020, and that encourages major destocking. But if rising prices were going to resolve that backwardation, it would have happened already, because prices, tripled since this whole end of the world COVID thing started. So the reason that they're not going to allow the stocks to completely disappear is that would expose the entire futures market for the sham that it is, and it would the rot would just spread to other contracts. So they have to stop it here. They have to nip it in the bud.
Well, Rafi, you've also recently started a YouTube channel, right? Wanted to share that with the audience. Here's a Rafi Farber. If you put it in there, I'm sure people can find your YouTube channel, but you're doing a lot more regular content online. And I'm sure if the audience knows your channel exists, you'll get a lot of new subscribers, because your videos always perform well when we have them on our channel. So everyone should know Rafi's got his own channel now where he's producing content. And for more Rafi,
I had a fun one today where I debated an Israeli doctor on the situation here.
Yeah.
Oh, really?
Yeah. That was that was just today.
Yeah.
I got a call to appear on the English Israeli news channel, and I ripped him a new orifice, let's just say.
Well, Rafi, thank you very much. We always appreciate you coming on and chatting with us. You're a very interesting guy. You have a lot of interesting insights into what's going on, and we hope to talk to you again in the next 2 or 3 months.
Yeah, I hope to talk to you too.